Good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, September the 3rd, 2025, recording this in the morning. Okay, I just want to start off by looking at the chart for Google or Alphabet. They had a fairly significant legal victory yesterday. There was a big monopoly case, which basically they won, and essentially the judge saying, this is the Google chart here, or Alphabet, that they didn't need to divest themselves of their Chrome browser or Android operating system. So that was a positive for, they had to make some other concessions, but overall the market is taking this as a sort of a good news, a bit of a victory for Google, and of course the broader sort of technology space. And you can see here that in the pre-market up quite a lot from, was last trading at 211, but in the pre-market at 224. So that's a positive here for Alphabet. And just in the broader space, if we have a look at the NASDAQ, you can see here that the NASDAQ, is still trading fairly comfortably along its highs. And we'll see today if there's any follow through with that news from Google. Having said that, we do start to get a lot of data coming in today. We have JOLTS, we have sort of ADP tomorrow, we have ISM services, we have obviously the non-farm payrolls on Friday. So we are going to get a lot of data, and it's going to be interesting in terms of the equity market, whether it takes sort of one or two tracks. I mean, if we get very, very strong data, will that sort of say that, there's a possibility that the Fed is less comfortable and less certain to hike in September? So that could be a negative for the equity market. On the other hand, we have a paradox that if the data comes in weaker than expected, it could be a sort of a sense that the Fed is, in some sense behind the curve or a little bit too late, and maybe Trump is right that Powell is too late, and that therefore that would be sort of a negative, and the economy is heading towards a slowdown, which could be a negative for equities as well. So interesting times, and just a little chart, just in terms of that, it's interesting. I think what the market seems to be saying, I just found this this morning doing my research. It's kind of an interesting little chart, just looking here at the city surprise indices, and a lot of people look at these. So this is on the right-hand side in the blue, and you can see here that the Citigroup surprise index is actually sort of positive. And what that is, that's essentially saying whatever the forecast is or the consensus for economic data, is the market coming in higher than expected, a beat, or is it coming in lower than expected and a miss? So if it's positive, it means that in general the data is coming in better than expected or higher than expected. So as you can see here, if you sort of agglomerate all of these things, we can see that in the blue that's actually going up. And ordinarily one would think that that could lead to maybe a more sort of careful Fed, a Fed which is more circumspect, less certain about sort of cutting in September, but we're not actually seeing that. And what they have here is the what they call the expected pace of Fed cuts. They're taking that as the 2-year yield minus the Fed funds rate, and you can see that that's actually coming down. And we is coming down, and would have got about minus 75 basis points or so. But the bottom line here is that generally these things follow each other. So you see that, as the data worsens in the blue, for example, the market prices in a more dovish Fed. As the surprise and the data comes in better than expected, the Fed becomes, the pricing is a little hawkish. So we are actually seeing a divergence here. And it's very, very interesting, because what this seems to be saying is that the market, in terms of the Fed funds rate, seems to be assuming that the Fed will absolutely, bar some kind of crazy disaster, cut in September, even though the economy, at least the economic data, is coming in a little bit stronger than expected. So that's kind of interesting. So that would lean towards, just let's have a look and see what actually is priced. And what we can see here, I'll just bring this up. What we can see here is, still over two cuts expected by the end of the year, 2.2 cuts. And again, if we look at the upcoming September meeting, we are still looking at a 92% chance priced in. So that equates to 23 basis points. So as far as the market's concerned, this is a done deal. So again, looking at the Citi surprise index, what would it take for the market to price out or reduce significantly the chances of the Fed cutting in September? I really don't know. It would have to be extraordinarily hot data, wonderful, super pumped up data, and very, very hot inflation, and maybe even something else. I don't know, some political intervention or something. So at this point, it does seem as though the September meeting is absolutely sort of baked into the cake, so to speak. And then, of course, what could be interesting is, on the other hand, if we start getting the cold data, does this sort of pricing of, first of all, this would probably go to 100% chance of a cut in September. And will this go, above 25 basis points, we start looking at 30, 35, 40 basis points priced in, which of course would be great for the front end of the curve and would cause a bull steepener. So interesting. So in terms of the data, let's have a look and see what we've got today, because as I say, things are starting to heat up. And we have the all important, well, when I say all important, it's the JOLTS number, which of course is the job openings and labor turnover. So it's the amount of job openings and also people, are they quitting? Are they being fired from their jobs? And these sort of, how can I say, sort of private indicators, they might become increasingly important and get more of the market's focus, because we know that the Bureau of Labor Statistics head was fired by Trump. So the BLS now has a new sort of head of statistics, the Bureau of Labor Statistics. And the point is, does the market have maybe a little less confidence in the validity of this data? I don't know. It's an open question. But if that could be the case, it means that the market will be paying even more attention, potentially, to private surveys like the JOLTS numbers and the, well, when I say private surveys, other surveys apart from the Bureau of Labor Statistics stuff and ADP tomorrow. So let's just have a look and see what's expected. Today we have 7.38 million is expected. So that in theory would be a little bit of a slowdown. And then we also have to look at things like the quits rate. Are people quitting? Expected to be in this number here, 3.13 million is the number of people who are voluntarily leaving their job. And remember that the theory goes that if people are quitting in higher numbers, that's normally a positive sign for the economy, because that presumably people quit because A, they think they'll make more money at another job, or secondly, because they don't like their current job, they don't like their boss, and they think that they could easily find another job somewhere. So that's a very important one to be looking at, is the quits rate and the quits level. And of course, then the layoff level and the layoff rate. And one of the narratives at the moment is that the market is, the labor market is in some kind of equilibrium, that people, there aren't that many new jobs, people aren't really being fired and losing their jobs. So it's in a kind of an equilibrium. So let's have a look at that. And let's just bring that up here. Just want to have a look at that. So this is the layoffs level. And as you can see, if we go all the way back to COVID, it's very, very flat. So there's nothing bad to see here. But let's I don't know, sort of take this out a little bit more and go back, let's say 2 years or so, 2 to 3 years. So is the layoffs level going down? As you can see here, this is quite a noisy number. There's no sort of obvious trends. But one could argue that there is a slight downward trend here. We shall see. Anyway, so the point is, that's pretty important today to look at all of the jobs, the JOLTS subcomponents. We also have, at the same time, 10 o'clock, we also have the factory orders, which is interesting just in terms of seeing, just obviously sort of industrial production a little bit. And we also then have the final number, so the second reading here of the durable goods. I don't know how market moving that'll be. So let's check out all of that. Okay, so going back to just where the markets are at, let me just bring this up. One market I do want to talk about is just quickly oil, which we haven't talked about for a couple of days here. And you can see that oil having a little bit of a sell-off. And again, I'm just going to throw up some moving averages here just to put this in a bit of context. I thought that might stall out. Hold on, let me see. Where is that? Right, there's our EMAs. Boom. Okay, so as you can see here, finding a little bit of resistance at the 100-day exponential moving average here, and also a lot of horizontal overhead resistance. And the proximate cause for that was there was some headlines coming out from Reuters this morning that at the upcoming, on the weekend, there's an OPEC Plus meeting. And apparently OPEC Plus, the rumors go, the headlines go, that they are considering another hike. So not a cut in production, but a hike in production, so increasing production. And of course, that's at a moment where there are some concerns that global inventories, especially going into 2026, will be rising and at a higher level, and that the global economy, some slowdowns, but perhaps in demand from China, perhaps from India, is potentially an issue and a problem. So quite interesting and quite aggressive if OPEC Plus decide to hike again this weekend. And just on the back of that information, the oil market here, the WTI, selling off about $1 or so. We'll see if that news is confirmed later this week or going into the weekend meeting. On the other hand, something which was a little bit more positive for the oil market, there were some sanctions imposed upon Iran yesterday by the US, so that's a positive. And of course, there's ongoing chatter, another aggressive and frankly quite odd tweet this morning by Trump on Truth Social, sarcastically, sort of saying thanks China and President Xi for cozying up to the leader of North Korea and Putin and whatnot. So it's all a bit weird. But having said that, there is the point I'm trying to make here is that there's also the possibility of tightening sanctions on Russian oil exports, which would tighten the market. So that's a positive. Anyway, let's keep an eye on oil. And as I say, at this point, I think there's no particular reason for oil to collapse, but there's also no particular reason for oil to be ripping higher. And certainly you see here, it's finding it hard to get through this sort of technical resistance, at the 100-day, and you see the 200-day still quite a long way away from that. So let's keep an eye out on all of that stuff. In terms of other markets, really what a lot of people are talking about is the rise in yields globally. So if we look at something like the UK, everything's calmed down a little bit. If we look at, we had a look yesterday, but let's have a look here on, actually, I think I've got this on the Bloomberg. So I've got the 30-year yield. So I'm going to just bring that up quickly, open that up. So I'm going to G, just give me a second here. Please, bonds, rest of the world. Yeah, developed markets. So what this is here is for most of the developed world markets is the 30-year yield. And this is normalized. So this is not actually a yield here. We're up into the fives for a lot of them. This is sort of normalized going back essentially to the end of last year, beginning of this year. And you can see here that most markets, the yields have gone up, but especially want to have a look at the blue one, which is the German one. You see the German yield here in the blue's gone up a lot. And of course, you see Japan here in this sort of apricot color here. So you see the German and the Japanese yields have gone up a lot on the 30-year. But also if we look at the UK, you can just see how that's also been steadily rising. And also we can see in the US, which is the white one, comparatively actually not as bad, but still global yields are going up a lot. And this is just on this sense that there's just too much debt. It's costing too much to service the debt. Inflation is remaining sticky. A lot of central banks have pulled back from obviously their quantitative easing, their QE programs, and even doing some QT, some quantitative tightening. So there's all these reasons. There's also potentially in the case of the US, less sort of independence in terms of setting monetary policy because of political interference. So the point is there are a lot of structural pressures at the moment pushing up long-term yields. And that's and we also have over in Japan, the potential for them to be hiking, and that's starting to cause a lot of pressure. And it's coming out in certain a certain sort of FX markets as well, and other things. So if we look here at we had a look at the pound. Now it has stabilized a little bit, but if you just look at the pound, which I'll find in a minute. Where's the pound? Here's the pound here. You see it's come down, or it's gone up a little bit today, but essentially it's been under a bit of pressure just on this idea that the UK is really sort of, running out of fiscal space. It can't really cut too much more, can't really cut spending too much more, but it can't really sort of stimulate too much more. And that the price, as the yields are going up into the over 5.5%, it's just becoming very, very expensive or more expensive to service that debt, which is creating sort of extra problems. So that's definitely something to be looking out for, is that the rise of the long end. And we see a lot of steepening everywhere. If we look in general, so let's look at the German curve, which, for example, the 230s in Germany, you can see that overall there's just been steepening and steepening, 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 even in the last, let's say, 2 weeks or so. This is the 230s, it's been steepening. Similar kind of situation in the US. Overall, let's have a look at the 230s. You can also see that that's been steepening as well. So overall, we have this idea that the front term bonds, or let's say the case of the US, is being anchored, as we saw, even despite sort of a slightly strong economic data surprises. The reality is that the market, especially in something like the US, the front end of the curve here is pretty anchored. The market is expecting the front end, to be stable, or if anything, for the yields to go down as the Fed begins some kind of cutting cycle, probably in September, but certainly, later this year and going into 2026. Whereas all of the pressure is being taken, as we see, by steepening of the curve, from, let's say, the 7s, 10s, 30s outwards. And that's what's the one which is taking this idea that the economy is, relatively robust, inflation is sticky, deficit costs are going up, and deficit spending are going up, or the cost of servicing the deficit. So just definitely causing a sort of a steepening of the curve everywhere. And what's benefiting from those kind of factors, a loss of debasement of fiat currencies, sticky inflation, less proactive central banks, especially in the case of the Fed. We see gold here. So let's just look at the spot price. And as you guys can see here, gold. I mean, what can you say? Breaking out of the range, new highs here on a gold spot against the US dollar. I don't want to use the word parabolic, but this is a super, super strong uptrend. If we look at the futures for the December contract, also breaking to new highs in the December contract, well above all the moving averages, of course. And silver, which is getting a benefit as well. And you look at silver here, as I pointed out yesterday, is pushing up towards sort of a very old price. I think going back to about 2011, up just over about $44 or so. So the precious metals doing pretty well. So it's interesting, is copper breaking out as well? Copper is sort of pushing higher, not as aggressively, but still copper is now starting to do a bit of a catch up. I think yesterday I was just waiting for that, but now copper, this is the London price, is starting to do a bit of a catch up here. And as the market maybe is starting to look for, sort of hard assets, or, just as trying to find a place where, sort of an inflation shelter, essentially, in hard assets. Okay, so I might leave it there, guys. As I say, we have the JOLTS number coming in this morning. That's going to be an important one. Trump seems to be tweeting away already, but that's mainly just sort of geopolitical sort of puffery more than anything. And I believe this morning also there's going to be a press conference, probably more on the political side of things, by Pultino from about Lisa Cook situation at the Fed. There's some new information that she was definitely using her house as a rental property, et cetera, et cetera. So the point is there, though, that there could be someone to replace Cook, definitely to be happening soon. And also we're going to have the hearings in front of the Senate for Stephen Miran to replace Adriana Kugle, who left for the Fed. So the point is that the Federal Reserve is definitely going more towards the influence of Trump, and we could get a bit of an update from that. Okay, so let's watch out for JOLTS. Interesting to see how Google trades and the whole sort of tech complex. And I'll also be keeping an eye out for any information about OPEC Plus and oil. Thanks very much, guys. Have a great day, and we'll keep this going tomorrow. Thank you.